portfolio as of the end of 2019. I sorted the companies by the rate of return during the last 3 months. Different from the dot-com bubble crash, when the technology sector performed the best before the recession, but later lost the most during the crash. I'm sure Warren Buffett feels now like a kid in a candy store. In the world where the toilet paper is a currency, Warren Buffett is a voice of reason. In these volatile times, let's look at the portfolio of one of the best investors and the fourth wealthiest person. The question is, how well was he prepared for the stock market crash? This chart shows the portfolio as of the end of 2019, as reported in Berkshire Hathaway's 13F filing on February 14, 2020. Watch this video till the end to find out what his biggest positions are, what are the main sectors in his portfolio, and how his stocks have performed during the 2020 stock market crash. First, let's look at the biggest positions and their performance for the last 3 months and the last 3 years. I sorted the companies by the rate of return during the last 3 months. We can easily see that technology was the best performing sector. Moody's corporation is operating in the financial industry, but it is in fact closer to information technology company. It is an American credit rating agency and provider of financial analysis software. Together with Apple, these companies lost the least from all companies. If we look at the return from these companies for the last 3 years, these companies generated Warren Buffett's best returns. Apple is the only company from this list which I own in my stock market portfolio. My portfolio is concentrated on technology companies, and the current crisis shows that it was the right choice. So far, these businesses performed much better than the overall stock market. Next, we have consumer defensive businesses. People do not spend on some activities now, but they still eat and drink their favorite products. These businesses are more stable than others, even during the contraction of the economy. People won't stop buying Coca-Cola or consume their favorite ketchup because they have less money than in good times. I consider both segments, technology and consumer defensive, as good options for the current times. And then there are sectors which I would avoid in my investments. The worst performers were airlines. These businesses lost 50% of their market capitalization during the period of the last 3 months. The second worst sector is banking, and that sector is heavily overweight in Berkshire Hathaway's portfolio. The reduction in market capitalization of banks for the last 3 months was between 30 and 43%. From the overall table, we can see that in general, the better performance during the more extended period, in this case 3 years, translated into better performance during the last 3 months. It is different from the dot-com bubble crash, when the technology sector performed the best before the recession, but later lost the most during the crash. Warren Buffett's stocks have been underperforming for some time now. I will prepare another video in which I will explain the reasons for the underperformance of dividend companies recently. Now let's look closer at these sectors. The biggest representation in Warren Buffett's portfolio is banking. Warren Buffett has often spoken about how important it is to have an area of expertise, and that is his area of expertise. Financial companies are shown in green on this chart. Warren Buffett owns shares of big American banks as well as shares of financial institution, Moody's Corporation, and payment service providers, MasterCard and Visa. In the video which I published at the end of October 2019, I told you that bank stocks are the right choice when the economy is growing. These are the times when companies and customers are taking out more loans. Banks stocks thrive when interest rates are high. In that video, I expressed my doubts if the significant exposure to financial companies is a good idea currently, in the low interest rates environment. Since that recording, bank rates went even lower, as the monetary policy changed for fighting lower spending caused by the fear of the sickness panic spreading across the world. The risk of this sector comes not only from lower profitability of banks, but also the latest oil prices crash. Just 3 weeks ago, oil prices suffered their biggest fall since the day in 1991 when American forces launched airstrikes on Iraqi troops following their invasion of Kuwait. Low prices of oil may lead to more defaults in the US energy sector. Banks' bad loans to this sector may lead to another hit to their profitability. So that adds to a pile of concerns for banks. Consumer defensive sector is the one next banking which Warren Buffett loves the most. Around 15% of Berkshire Hathaway's stock portfolio is in consumer staples, which are defensive companies. The beauty of consumer staple companies, as the name implies, is that they sell products that are high on consumers' shopping lists. Regardless of whether the economy is strong or contracting, there's little chance that consumers are going to change their buying habits. It makes the sales and cash flow for consumer staples very predictable. In part because of that stability, stocks in this segment tend to pay generous dividend yields that have a long history of rising each year. The most significant position in the consumer staples sector is Coca-Cola, which Buffett has held for more than 30 years. His second biggest consumer staples company is Kraft Heinz, which was not such an excellent investment as you can see from the return for the last 3 years. Among the 4 main sectors in his portfolio, 2 industries are too big to fail sectors: banking and airlines. This time, it looks like airlines are going to be saved by the taxpayers' money. Warren Buffett owns shares of 4 major US airlines. The yellow color on the chart represents airlines. It is not a surprise that these stocks experience the most significant decline. People do not consider traveling now when there is a risk of getting an infection. I left technology for the end as it is mostly represented by one company. But it is also the biggest purchase by Warren Buffett. He initiated a significant position in the Apple company 4 years ago. The iPhone maker has since become Berkshire Hathaway's single largest holding. Exposure to technology companies is something which Warren Buffett avoided for a long time. He considered technology to be outside of his circle of competence. But it shows that investing strategies have to evolve. The economy is changing. People use some products or services more. Some others get obsolete. And the company or the whole sector can be in its decline. Why does he like the Apple company so much? He has said more than once on CNBC that he loves the power of Apple's brand and its ecosystem of products and services. Apple was the right choice of Warren Buffett. But there are more examples that his slow transition to technology lost him potential bigger gains. Only one technology company in his portfolio shows that he missed the transition of the world to digital. He praised Alphabet but finally decided not to put his money on this advertising giant. Warren Buffett admitted to shareholders that he made a mistake by not buying Google shares years ago when the company was getting $10 or $11 per advertising click from Berkshire Hathaway consumer insurance company subsidiary Geico. Recently, Berkshire Hathaway initiated a tiny position in Amazon, which is a sign that he is changing his mind on tech. I consider companies from technology and consumer defensive sectors as good choices for the current crisis, but banks and airlines were among the worst performers so far. Warren Buffett missed on the opportunity to invest in tech companies more heavily before the crash. Tech companies showed the best performance in the last few years and similarly lost the least during the current stock market crash. But there is another aspect which shows the wisdom of Berkshire Hathaway's CEO, a huge cash pile which he can now deploy on buying shares. Warren Buffett, or rather Berkshire Hathaway, had over $130 billion in cash. He has accumulated the liquid assets in the last few years, and he is now ready to increase his exposure to the stock market. I'm sure Warren Buffett feels now like a kid in a candy store. I'm going to prepare a video about the latest changes in his portfolio and acquisition targets during the last few months. Do you think he's finally dumping bank stocks? Subscribe and click the notification bell if you want to be notified when the video is ready. Which companies from Warren Buffett's portfolio do you have in your portfolio? Have you been buying or selling shares during the first quarter of 2020? Comment below and share your investment ideas. If you enjoyed this video, feel free to add me on Instagram, Stocks and Freedom. Thank you so much for watching, and until next time, happy investing!